When investing, you put your money in a company hoping to make more money off of it. It's a pretty simple premise based on just that, but you have to consider a lot of different things to be successful. You can't just throw money willy-nilly and expect to get compensated well for your initial investment. What if we told you that you can boil down tons of knowledge into some tips that you can apply in investing? This is Intelligentsia, real-life advice for practical and financial goals. What we want to talk about today are key takeaways from the intelligent investor and how it could benefit you. So let's get to it. When you invest, you have to understand that there are things that the market does that doesn't always make sense. You can find an incredibly low price for a company that has good financial health, great management, and a good place in the market, and at the same time, you can find an overvalued stock for a company that's not as known, doesn't have the best financial management, and is virtually non-existent in the market. The point we're trying to make here is one of the key takeaways that you can get from the book is the importance of fundamental analysis. Fundamental analysis is a way to evaluate and value securities like stocks or bonds. It's based on the intrinsic value of the underlying assets and the financial health and performance of the company. The goal is to determine whether a security is overvalued, undervalued, or fairly valued, letting you, the investor, make informed decisions about buying, holding, or selling investments. What you need to do when looking at a stock is checking whether it's priced right. If the asking price is reasonable for what they're trying to offer, then you may have a purchase waiting for you. If you look at a company's financial health, you'll realize whether or not it's a good buy for the present. And if you look at their position in the industry, you can tell whether or not it'll be good to keep in the future. The key components to look for when analyzing a company's financial health are income statement, analyzing revenue, expenses, and profits to know whether or not the company is making money, balance sheet, evaluating assets, liabilities, and equity to know whether or not a company is in a good financial position, cash flow statement, understanding a company's liquidity and capability to generate money. In terms of the stock's intrinsic value, there are some things that you can take note of in order to understand whether it can be valuable for short-term or long-term holding. Some of the things you should be on the lookout for are earnings per share, price-to-earnings ratio, dividend yield, book value, debt and leverage analysis, management and corporate governance, and industry and market analysis. Long-term investors generally use fundamental analysis to make investment decisions based on a company's financial health and long-term growth potential. It requires a lot of investigating and comprehending the factors influencing a company's intrinsic worth, such as its financial statements, management team, competitive position, industry trends, and macroeconomic climate. It is crucial to note that fundamental research is only one technique to investment analysis. When making investment decisions, investors may also examine technical analysis, market sentiment, and other aspects. Since you'll be evaluating a company's intrinsic value, there also comes the idea of you wanting to be secure and knowing that the company you're investing in is safe in the long run. After analysis, you might have determined that there's a certain level of safety you're comfortable with and that you want to be able to maximize your returns despite betting on something safe. One key thing to take away from the intelligent investor is the importance of the margin of safety. Graham emphasizes the concept of a margin of safety, which talks about purchasing a stock at a substantial discount to its real value. This strategy protects against potential market losses and uncertainty. Basically, what you want out of this is you want to look for a company with a good financial position, stable earnings, and good track record. If you calculate the intrinsic value of stock and buy it at a significant discount, you'll be ahead of the market and you'll be buying something of more value at the price you're paying for. If the company is performing as expected or more, then that means you won't be investing your money in a company that'll go under soon. What you want is a company that can stand the test of time and provide value for a long period. A company that grows in value also grows their stock in the market. And if a stock in the market grows in value, then so does your money. Always investing with a margin of safety in mind not only protects your investments from possible downturns, it also allows you to make wiser decisions in regards to choosing a stock that you'll hold on to for an extended period of time. That said, knowing how to defensively invest in the market allows you to preserve your investment, but it doesn't necessarily translate to the heights of what you can possibly obtain from the market. which is why one of the other takeaways from the book is knowing the differences between aggressive investing and defensive investing. When you look at the margin of safety, you generally want to invest defensively to preserve what you have and be able to invest in a consistent stock. If it's performing, it's rational to expect to get your money back, albeit not in the same surge as you would from investing on a lower performing one that manages to spike up in value. Investing is making a choice between risk and reward. Do you want to invest in a low performing stock that can shoot up in value in a short period of time? Or do you want to invest in something safe and proven that increases slowly over a long stretch of time? Aggressive investing involves taking on more risk and volatility in pursuit of higher returns. You may not win every time, but the return is exponentially bigger compared to defensive investing. Defensive investing, on the other hand, prioritizes preserving capital and minimizing risk. While there's no right way to invest, generally long-term holders prefer defensive investing over day-to-day traders with aggressive investing. What you want out of the two methods strictly depends on the risk tolerance that you have for your investment. If you're someone that's aware of the trends and can see where the market might take a low-performance stock, perhaps after further analysis, you may determine that a certain stock might actually be good for you in the long term. Whereas if you prefer to invest defensively, you may lose out on money that you could have had if you decided to analyze the situation for what it is. Keeping an eye out on the market daily is certainly a daunting task that requires effort in order to be successful, but that's only one way to invest in the market. Understanding the moods of the market may be a tedious task for some, but what you want out of it is to see the trends and not immediately be influenced by the market's moods. Which is why one of the takeaways we'd like to talk about next is understanding the market's moods. With the market ever changing, you have to know that it's not always going to be rational. Sometimes a stock's price is overvalued. Sometimes it plummets at a significant enough discount for you to buy it. What you want out of this is to not be swayed immediately by the changes in the market, but rather to look at a stock's intrinsic value with proper analysis, and to know whether the stock's valuable without looking at the price itself. It's important to note that you'll be buying it and then holding it for a period of time, whether it's short or long term. And as a result, the factors that determine whether your stock is valuable isn't the initial price you bought it for, but for the company's financial health, management, and growth potential. If you believe that the stock you're buying is good in all three of those areas, and it's priced at a manageable enough price for you, then it would be a great idea to buy it and hold on to that stock. With everything mentioned, it's important to mention that the market changes and investing always involves risk. While you can't always avoid risk, there are steps to mitigate it and maximize your rewards. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fit together.